Yeah, I wanted to share something with you while I'm waiting. Had a fun one. This is, where you go? I had a coaching. Lisa's question came in on Monday. She sent me that email on Monday related to that bull put spread on SPX, and we had a coaching session today. We might talk about that in a moment too. But what I shared with her is what I did on February 7th. We know January was bad, and I had mentioned to some of you that I normally do the 2-week out bull put spreads, but once the SPX went below the 20-day moving average, I put the weekly ones on hold. Okay, I didn't do the 2-week out bull put credit spreads because the market felt off to me. So, but here are the actual positions I did, not the actual contract size, mind you. This was part of that question that came in from Chuck. This is something I want to put together too. For Chuck, if you only had $1,000 to invest, how would it start it? What I was attempting to illustrate here is how dangerous it is to open 3 or 4 spreads with just $1,000. Also, that you can only do 1 contract or maybe 2 contracts at a time. So we're not talking about a lot of money here. $60, $29, $33. Ignore that $234 for a moment. But I don't have it up. I wanted to put this more together. I'll put this together more in slides. It'll be a blog and a little video that'll come up here. But this is my bull put credit spread. Why do I have a bear put debit spread in this position? On February 7th, excuse me, I opened 3 bull put credit spreads. Zscaler, 232.5, 230. The stock was at around 258, I believe. We can check that in a moment. And it was a net credit of 33 cents for a 15.2% return. MasterCard, 352.50 put by the 350. Net credit of 29 cents at the fill price, 13.1% potential return. And both of these expired today. IBM was a bull put credit spread. Sold the 131 put, bought the 129 for a net credit. Let's go into our notes here. This is exactly how it looks in my account. This is exactly the process here that happened on this trade. Sold the 131 put for 76, 129 put for 53. So we're essentially at a 23-cent net credit. IBM is at 137.40. This was on the 7th. It's reading 2/18/2022 because I copied over what I have in my actual account to here with the notes. Now, February 10th. First of my warnings that I talk about. 8 days to expiration. Stock IBM fell below the SMA 20, dropped below 134. So this is 3 days after we opened the position. MACD just turned negative. The 1% rule had me at a stop at 132.30. It was trading at 134.34, so I hadn't hit the 1% rule yet. Liquidation loss right now was a loss of $15 to $25 as it bounced around midpoint. The max loss was 177. On, where did I not put the date? I'm sorry, folks. This was the 10th. This was the 14th. There it is. I'm sorry. I put the date up here. It was on the 14th. What happened on Monday is the stock continued to decline. Where is it? That's my first warning hit. This was on 210. This was on 214, I believe. The SMA MACD alerts triggered a few days ago. Stock dropped below the short put strike this morning. That's right. On Monday, it opened, and it was trading at 130.70, and I'm holding the 131 put. But as I'm tracking it, I noticed there was an opportunity to do the pendulum adjustment. And what I was able to do was sell to close our 129 put for 120 with the stock at the stock was not at 124. That's today's price. I'm sorry, the stock was at 130.70. So we closed it at 120 and we bought the higher strike 133 put for 292. The pendulum adjustment, will show that in a minute better. And so here it is. SMA and MACD alerts triggered. Stock dropped below short put strike price. Applied the pendulum adjustment. So now this is a debit of 167 on our 2-point spread for a max return of 33 cents, which was oddly higher. Oh, I'm sorry, it was 310. That's an errant entry. It was 310. 33 cents was oddly higher than the initial bull put credit spread of 23 cents. So let's take a look here at how that panned out over that time period. So this bear put debit spread was closed at 4 o'clock, essentially bought shares of stock at 131 and sold them at 133 to get the 2 points back. Net debit was at 167 in that case. There we go. So it was a 19% return as IBM fell from 137 or 135. Yeah, it was 137 when I opened it. Fell to 134. It fell below the 20-day moving average. MACD went negative. And then Monday the 14th, it opened at 130.70. It fell below the 131 strike. So we took the 129 put, rolled it to the 133, turning our bull put into a bear put debit spread. And it worked out because IBM continued to move down in price. So that is a fortunate example, but a good example of the proper application of that pendulum adjustment in a credit spread format. So the initial position, let's see, we sold the 131, and this was 76. We bought this one at 53. And that was on February 7th. Okay, so that's the initial bull put credit spread of the 3 that we opened. Let's take a look at the chart real quick. February 7th, there we go. Right here. I mean, it had everything that I wanted. It was still riding a positive MACD at the time, though it was close. It was moved above the 20-day moving average. It was looking good. It looked good for the first couple days, and then this. So it was on the 14th. The 10th was the first warning signal that triggered, and on the 14th, right there, right around in here, excuse me. Yeah, it's right around in here, I think, is when we made the pendulum adjustment for the last 3 days. That was right here, I think. Yeah, right in that time frame. That's when we applied the pendulum adjustment. And so what did we do? What was the actual action? That's one of the 8 ways we use to manage a bull put credit spread if we think it's going to continue to be bearish and if the money works. And in this case, the money works. So what did we do? We sold the 129 and bought the 133. We left the 131 there. So in one move, we turned a bull put credit spread into a bear put debit spread. And how that works out mathematically, of course, is we had a net credit of 23 cents in pocket. We sold to close our 129 put. I believe was that for... I'm sorry, let me take... I can remember it was a 129 price as well. No, 120. Straight 120, I'm sorry. Great. So we sold the 129 put for 120 and bought this was actually 310. Bought the higher strike for 310. So we're going to sell that at 120. And bought this for 310. And that's what created it. So again, we got a full debit. All prices included is a debit of 167, now on a 2-point bear put debit spread after the pendulum adjustment. Sold the 131, bought the 133, 33-cent return against that 167 net debit position. So it worked out well in that case. But now, because I technically had a loser of the 3 bull put credit spreads that we entered, managed it to a winner with one of the income methods, I'm kind of hesitant to go back to bull put credit spreads for next week's cycle. I do have an extra one on BA, which is getting really, really close. In the market the last 4 days, everything's dropped. I opened this one on February 11th, but it's getting really close to our 1% rule. But it hasn't triggered the other alerts that we've set yet. The 1.1% limit. Hey, I can do that now because we got that percent option limit updated, and the stock's still trading above its 20-day moving average. So we're doing okay there on that one, but it's at 209, and my 1% is putting me at about 207. Oops, I'm sorry. I'm going to go back to the portfolio in that case. So that one's getting pretty close. But yep, got good with these. So position actions, let's do some cleanup here. Expire all options. MA ended at 369.95, the 352.50 and 350 expired worthless. So we go to position actions and expire all options. Yep. And Zscaler, same thing, 230.250, 230 there in that case. Position actions and expire all options. Okay, and still got time with BA, but again now the IBM Bear put debit spread, essentially we're going to close this out for 2 points, get the 2 points back, make a 33% profit on that investment of 167 in that case. And just to let everyone know, let's go back. Let me go bull put credit. I know we're going to go into back test for a minute. And the question is, well, how did you, Mike, the trades you're mentioning, you opened them on the 7th. How did you find them? Well, this is straight from my default search that I use. Okay. I did do some research and analysis. I don't know if the same ones are going to come up. Remember, it was MasterCard, Zscaler, and IBM. Of course, Tom says, I don't know if you should mention what search you got them from, since only 2 out of 3 were successful if you hadn't managed it. Oh, it's a point there, but it's also been a bad market, of course, for bull put credit spread. So I'll accept that. That's perfectly fine. But the weekly default bull put search is typically what I use. It's looking for 14-day out trades. The one that for the 25th expiration that you saw, the Boeing trade that's still in the portfolio there, that was opened on the 11th. I had some extra cash available, so I opened a 4th spread on February 11th for February 25th expiration. Okay, so all right, I opened those trades roughly at around 11:30 to 12:30, somewhere in that time frame. It was 11:30 to 12:30. There's the IBM trade, the exact same one. It's there. ZS is not on the list, but there's 115 results. So ZS is probably still in there. It's just not in the top returns at the close. So when the market closed, it was different than when it was the other day. But you see the IBM is there. Let's just take a look. ZS. Did match the criteria at the time, at least during the day. So I'm expecting it still being here. Might not have the return if it started to move up further. There it is. Same strikes. Yep. 232.50 to 230. 12.6% return. I got in at 13, I think, with the slightly higher net credit. So that was in the search results on February 7th. The exact same strikes, just wasn't on the first 15. And I'm sure MA is going to be in here as well. So yeah, they came directly from this list. Now, why are you not seeing them? This was the close of Monday, February 7th. Why are you not seeing these positions in the top 5 or the top 10? It's because I was running it in the morning, right? This is at the end of the day after the stocks have done their movement. All 3 are in the list. I think this is different strikes. I think I had the 352.50 and the 352.50 and the 350 on MA. This one had a higher strike, the 355, 352.50. But all 3 are there. They came directly from that search, where if I was feeling more confident in the market, what's going to make me feel more confident in the market? Hey, market's closed on Monday anyway. So, of course, naturally, those of you trading weekly options, you're going to have 1 day less of time value if you start opening new positions on Tuesday tomorrow, but you know that. This is that weekly bull put default search. If over the weekend, in reality, for actual, if they actually do it for real instead of propaganda, if Russia pulls back 50, 60% of its forces and has them return home, I'm going to feel a little bit more bullish on the market. I'd like to see a little less jobless claims being filed. I'm sure we all would, for all of our fellow Americans, of course. We'd like to see a more robust economy getting back to normal. But we were hitting a lot of hiccups recently. And let's be honest, inflation, it affects everybody, and no one likes to see it. But it's there, and there are reasons why it was caused that we might not all agree with. But in any case, not 100% sure if going to bull puts is available. I'm not making any recommendations or suggestions. This is where I do find my trades, and I pull right from this list for those trades that I enter. But I do look at the stock chart, the company information, do some research into each one. Those 3 that I entered, Zscaler, MasterCard, and IBM, weren't the top 3 even when I ran the search. I looked at the first 2, I forget what they were, and I didn't like them. I didn't like the chart. They had just had a recent breakout, and they were coming down from the breakout. It wasn't, to me, a true strong pattern. I think I even wrote in my real notes in my actual account, the IBM made me a little bit nervous because I didn't feel as far out of the money as I should be. But I was like, it's IBM. It doesn't move that much. And that's weird. I had one of those intuitions there about that trade, and it just kept going against me. But we were able to manage it for a profit in that case as well. Pavel, this is where I was going. Pavel, excellent comment. Thank you. During Lisa's discussion today, her coaching session today, she didn't want to discuss that at the money concept again. I sent her an email about it, told her I was working on the presentation. We showed some of it today. What she wanted to know is, what are the best trades for this market? And again, there's no one trade that works 100% in the markets. But as I told her, I'm not sure if I'm set and comfortable with bull put credits. Doesn't necessarily mean that I'm comfortable going into bear call credits on Tuesday when the market opens back up either. We'll have to digest the news from the weekend, the events of the weekend, and see where the market thinks we are as well before I feel comfortable going one direction or the other. Pavel says bear put debit spreads has worked quite well the past 3 to 4 weeks. Excellent. Ernie's still been doing that thing he told me about. He told me about it late. He told me 3 weeks or so after he was doing it, had some success with it. But what Ernie was doing was buying a put in January. He's buying puts on different larger stocks and even QQQ and SPY. And as the market went down, when he got a good enough reasonable return on that put, he would sell to close that put and roll it down to a lower put at a cheaper price to pocket some of the premium and then convert it to a bear put debit spread. So he was taking profits off early on the long puts if the market moved the way that he wanted, rolling down to a lower strike put and creating a bear put debit spread in that case. A lot of investors are very fond and very comfortable with the at the money debit spreads, meaning if QQQ is trading right at around 440, for example, I might sell the 440 put right at the money and buy a higher strike 445 for the bear put debit. And at the money spread might only cost me 260, 270 to enter it. And I'm looking to get 230 or 240 back, close to 1-to-1 risk reward ratio. I got to be honest with you, in this uncertain market, I'm still only, if I'm opening any spread, I'm still focusing only on spreads with an 80, 85% probability or higher. I'm only doing out of the money bear call credit spreads with at least that 85% probability, and in the money debit spreads with an 80 to 85% probability. Yes, it still carries an 8-to-1 or 7-to-1 risk reward ratio using the out of the money credits or the in the money debit spread. So now, of course, that in the money debit spread, I might be paying 440 on a 5-point spread to make 60 cents. But I'm starting off deep in the money where the stock has to make a significant movement in that direction. And if something changes overseas, something quickly changes with the economy, we might see a faster jump up in 3 to 4 days than we expected to see. And that would be all right. But you got to be nimble. My best advice, as I mentioned earlier, I still like the long callers, but my best advice to Lisa is if you're going to do spreads, go for the higher probability. Don't try to stay at the money, because that's what sort of happened, unfortunately, with that SPX trade she was in. Remember, when she started off, she had that 4,570 strike put in that case. It wasn't a bear put debit, it was a bull put credit spread. But at one point, she was almost $80 in the money. And the stock was down to, SPX was down to 44.83. And then it went up above the price, and then it came back down a little bit. I don't want it to go around my strike prices in a debit or credit spread. Now, the argument is true. I'm talking about in the money debit spreads or out of the money credit spreads, 8-to-1, 7-to-1, maybe 9-to-1 risk reward ratio. And a comment comes in and says, well, I know you're saying that you want that higher probability, but wouldn't you be better off with just a 1-to-1 or 2-to-1 risk reward ratio using the at the money debit spread? Never do an at the money credit spread. No. At the money debit spread. Well, yeah, but if I open 10 trades, and I lose 1 or 2 out of these 8, what does this also mean? This is a 45 to 55% probability. So if I lose 5 or 6 of these trades with a 2-to-1 risk reward ratio, I'm still not getting ahead. If I lose 1 of the 10 trades here at an 8-to-1 ratio, right, I might still be at a break even or a little bit above it or a little bit below, but I'm still doing the same thing here. Okay, if the movement happens in the opposite direction, that's what we watch out for. I haven't seen him on a webinar. I think he came in a couple weeks ago, but he didn't have any questions for us or comments. Sam did resubscribe to PowerOptions a little while ago and is back in using the tools. And I mentioned to, let's just go to the custom spread tool. I mentioned to Lisa, it's hard right now because volatility is high, but I remember what Sam used to always talk about, what he used to like to do, is he would do maybe 60-day, 90-day out long strangle positions, out of the money strangle positions. And let's go April. Let's just stay with April. Now, volatility is high right now, so these might be pretty expensive, but let's just say let's call it 435. Let's do 10 points. 445, 425. Right? The puts are more expensive than the calls, it looks like right now. We saw that sort of earlier in that discrepancy with the Black-Scholes calculator too, where the puts were at a higher price than the calls right now. I don't know exactly what Sam did or what his triggers would do, but he was constantly doing these 60-day or 90-day out strangles. And he's not just leaving it alone. If the market turns bearish, if the market starts to pull back, what he would do is sell weekly calls against this long call at a lower strike. So essentially now he has a bear call credit spread with a long put. And he'd let that premium hopefully expire, and then that would knock down the cost basis of the strangle. Then if it moved back up, he would sell a put against this long put for a weekly. It's sort of a calendar spread more than a credit spread, because he's not doing the same expiration. This is out to April. This is just a 3-day, 5-day, 7-day out position as the market starts to show a direction. And he's selling a put there, sort of creating a calendar put spread on this side, a bullish calendar put, lets it expire, lowers the cost basis on the whole strangle again. And if there's a large enough move where he has a reasonable percentage profit on this position, he'll sell to close it and maybe move it up to a higher strike. I don't know the ins and outs of it, but if the concern is, your forward-looking sentiment is that we're in an uncertain market that seems to want to go in this direction, as Pavel mentioned, the bear put's been working out very well for him. They've been working out very well for Ernie as well. Of course, we have searches for in-the-money bear put debit spreads with a higher probability, and in the sample searches view, there's an at-the-money debit spread screen that you can use as a stepping stone to create your own search. But if we're expecting an overall downtrend, knowing that something could change where you might see a sudden spike upward, whether that's globally or whether that's nationally or whether it's locally, then we start to see some increase in the market, you have the ability to adjust these positions and you're giving yourself more time. I'm not opening a 5-day out strangling, just hoping it goes 5% up or 7% down. I'm treating this sort of as a long-term investment that I'm going to manage and move up and down as the market moves up and down potentially. That was some of the raw ideas that I got from Sam about what he was doing with his strangle positions. And it might be a reasonable thing to do in uncertain markets. But now that volatility is back up to 28, the VIX is back up to 28. It was as high as 33, 34 a couple days ago, I believe. We're back to 27.75, just under 28 in this case. That's still pretty high from the norm, so those are expensive. You saw it would be, $21 total, $12.80 roughly for the put option and $9.50 for the call option, a little bit more than that. So the total debit would have been around $22 for that strangle, and that's fairly expensive. It's $2,200 for one contract.